Hi, it's Ray from CappThesis. Today we'll be discussing what the most recent negative reversal for the S&P 500 means, how significant it is that the index finally broke that long-term uptrend line. We're also going to analyze 3 specific indicators to give us a clue if we are indeed due for a bigger pullback. So let's get into it. This is the first chart here showing this negative reversal, outside negative day, bearish engulfing pattern, whatever you want to call it. And obviously it brings a negative connotation with it coming after the S&P was up 28% in a little over 5 months now. And so it brings back memories of what happened back on July 27th of last year. Again, the market was up 20% from that March low, had that very substantial outside negative day, which was followed just by a few days actually of advancing action, but those were very small, obviously occurred within the confines of that big candle, which then eventually led to an 11% pullback down to the October low. But not many people are talking about the addition that happened on December 20th, just last year. And if you recall, it was being attributed to the zero data options activity that day. And actually that was the day that we had the worst breadth of the entire time, below 10% of the S&P 500 stocks actually up that day. So what happened? Not much. We got a few more days of advancing action, couldn't quite get the upside breakout there. Ultimately, we basically went flat for about a month, right? We had the tough start to the beginning of the year, but that was quickly bought and off we went again. So of course, the question is, which edition is the current one currently like? Is it going to lead us to a much bigger correction that some people say are overdue? Or is it just another head fake within the confines of a much bigger advance? And so the other part to consider, of course, is that the S&P is now below the long-term uptrend line that he had stayed above up until the last week or so. Each one of the times we saw it tested, most recently in March, led to a bounce, but now it's becoming much more difficult to stay above it. Not surprising, right? We know this pace can continue, and as the market continues to go higher, it's just going to take a different shape, if nothing else. And so best case scenario is just to rally back above the line. But I would say the most constructive course of action right now is to use this period as more of a consolidation type phase, right? Digest more of what happened and, form more bullish patterns. We haven't seen one longer than, taking place over the last, few weeks in a while, and it just takes time for that to occur. The biggest one, of course, happened over here. We talked about before, finally hitting 5,030, but we had to go through multiple months back and forth movement. Some of it didn't feel that good to actually get there. So, that's one way of looking at it. The other part is that, the worst case scenario is that this leads to more substantial downside action like we saw after the last few uptrend lines were broken. We talked about this chart before. It didn't capture the entirety of this corrective move each one of these times, but it got the majority of it. And as we can tell here, a lot of times it wasn't a straight shot lower. I would say in particular what happened back in July and August, where we did have that move down through most of August, but there's a pretty substantial rally in between that got right back to the line in September, as September began, or as August ended and September began, and then really things took off from there. So what will this one give us? Again, we just talked about a few scenarios, but there is a concern, of course, that something similar could happen just because we haven't seen anything more than a 2.5% pullback up to this point. And so looking at this from a weekly perspective, same type of thing, where this rally took a long time to get back up there considering where it came from, but once again has gotten back to the top of this long-term trading channel, which starts at the beginning of October 2022, with the last 3 rallies hitting that line, consolidating near it, and then rolling over. And this really looks at those same 3 pullbacks that we looked at here after the uptrend line break. And so the biggest pullbacks happen after getting to that line and rolling over, with now dealing with that over the last 3 weeks. So as we concern, of course, is that this becomes a much bigger pullback. So the question is, what can prevent that from happening? And so we're looking at three important indicators in particular that help guide us along the way. And they're simple ones, but very important nonetheless. The first one being the 20-day moving average. And so needless to say, we're now testing or even below the 20-day moving average now, where before each one of the visits, which only started at the beginning of this year, led to buying opportunities, which of course gave us new highs, happened in, of course, January, happened again in February, March, now April, starting off the month, testing it right away. So the question is, if we finally go below that line, is it going to be an indication that we have a much bigger pullback? Well, it happened here in August, right after, again, a big 20% move. When it finally broke below it, even though it went back above it later in the month, it really couldn't get too much more extended from that line, which kept the pressure on. And so looking back to the summer months of 2022, every time we saw the S&P first break below the 20-day after spending an extended period of time above it, did lead to, again, some corrective action. We saw it, of course, after the big bear market rally in the summer of 2022. We saw it again as the January to February rally faded in 2023. And most recently, back again, end of July, early August. But since then, what's happened? The first time that it poked below it briefly back in the beginning of 2024, right? This year, nothing. Again, February, again, March, and now April is being tested once more. And so it tells us that, yes, at some point, we'll probably spend some more time below it, but we've seen in the best markets that it can persist for longer than we think is possible. And we also see that from a Bollinger Bands point of view, which is the next indicator that we're looking at. And that's important because, as we know, the 20-day moving average is the middle line of the Bollinger Bands, with the upper band being 2 standard deviations above the line and the lower line being 2 standard deviations below it. And so again, same type of thing where it's now testing that 20-day moving average or a middle line. Now, if we go back to what happened in July and August, when it finally broke below the 20, it instantly hit the lower band and basically just stayed near it, even after coming back from some bounces here, where even though these are thick lines, if you were to look at this more closely, the S&P didn't get back above the upper Bollinger Band until November, mid-November of this most recent rally. So, a good amount of that move, or at least the initial pop, was already in place, meaning that it spent much more time near the lower band during that time frame. And that's what happens when you have markets that continue to roll over. So the bottom line is, we'll get a good sense of how strong this market is, how interested buyers continue to be, if and when we get back down to that lower line of the Bollinger Bands, and to see if it's bought or not. Because going back to 2020, 21, very substantial rally, very consistent, very mature for that matter, but it didn't stay above the 20-day moving average the whole time. In fact, if you can see, a lot of times it went below it. But what happened? Most of the time, when it got back down to that lower band of the Bollinger Bands, marked a buying opportunity almost immediately. Not all the time, but that's what happens when you're in a big rally like this. Dips, of course, have been bought only after 2 or 3% pullback so far. We don't expect that type of low volatility to persist. But if things continue the way they are, and if we're due for a much bigger rally, longer rally than we've seen so far, then getting back down to the lower band will provide a buying opportunity once again. It's very important to see what happens once we test that line for the first time, whether that's going to be soon or in a few weeks or a few months from now. And so from a weekly perspective, we talked about this one before, but very good just to go back to it every so often to give us some perspective from a longer term point of view. And that's the fact that we've been hugging the upper line here now, really since the early stages of this rally, and staying right there. So it's going to take a long time, or I should say, it's going to take much more weakness to pull that even back down to the middle line. Again, it's a 20-week moving average from a weekly perspective, even more so to hit that lower band. And as we can see here from 2017 on, it captures a few different type of market environments, with the most substantial staying near the upper band and the middle line in 2017, early 18, and again from 2020 to 2021. And so this is why we shouldn't get overly concerned when we have a pullback right now. Is really about how the market reacts to it. And so far, nothing has changed from this weekly perspective. And so the last thing we'll look at here from an indicator perspective is just MACD. And we've also continued to get MACD sell signals. Talked about this before. There have been 9 before this most recent one since the springtime of 2023, and 8 of them have proved to be false readings, meaning that the market has continued higher, where sensing a flip of momentum from a MACD perspective just hasn't worked out. And it just tells us what type of market that we're in. It's not just the MACD. We talked about the RSI, of course, getting overbought for the first time in November, and really hasn't mattered from that perspective, because being stressed from an indicator perspective, having sell signals not work out, which is a sign of strength. But we look at all of these things independently of one another. It's good to know that none of them have worked. At some point, they may work again, but just showing that momentum is slowing down without downside follow through has not been the recipe to expect much more downside yet. And so we have another chance for the bears now, where there's another potential, downside or momentum shift for the MACD sell signal. But again, we go back to that 2020-21 period where there was 14 out of 15 sell signals were false readings as the market continued higher. Of course, things changing in a knowable way, 2022. So we'll know it at the time. The thing is, we won't be able to pinpoint the top because we don't know which one of these will work. And this is why we look at patterns so closely, because we have to see some damage come into the system for those to work. But eventually, a lower high will produce a bearish pattern, which could eventually play out. And that's really what's changed in 2022 as that began. And so, we aren't at that stage yet, but this is the type of things we're looking for to get a sense of when momentum can actually shift. And so from that perspective, each one of these could have been that topping pattern, which caused the market to roll over, like we saw from July and August last year, where each one of those failed rallies, right, turned into a successful topping pattern. Whereas we're still waiting for this one. This one looks a little bit more substantial as of right now, but we've seen, of course, bearish patterns have been negated numerous times. And at CappThesis, we look at this and on a more short-term point of view, so each one of these potential tops looks much more like a bearish pattern if you look at this from, say, a 2-hour perspective, which we try to do just, again, to get an indication of when things could possibly change. But as of right now, the only pattern that we have live from either a bullish or bearish perspective is the much bigger breakout that continues to be in play. And so, again, it hasn't done much over the last few weeks, but it just means that the S&P continues to be 7% now above the breakout zone. So it could definitely pull back much more than we've seen and still keep this upside target intact. And that's, what the big picture, that's the most important thing, regardless of what happens over the next few days, few weeks, and even a few months, because the market could pull back much more than it has. And again, this upside target will still be in play. So to get a sense of when that could change, again, we look at this on a day-to-day basis. We look at a number of different data points. These are just some of them, but a few things that we want to keep track of are, number one, how the market closes. And so, from a long time, it was running about 80% of the time with closes above its midpoint. That started to shift a bit at the end of March. And into the beginning of April, we had 6 out of 7 days when the market closed below the midpoint. As we can see here, it didn't really come with too many big down moves. A lot of times it was actually just, a small up move as well. And so this is around the holiday week, right before Easter, right after Easter. And so we have to understand that part of it. At the same time, we're trying to identify changes in the market. And those changes are much more prevalent, or I should say, the first step of that is seeing that on an intraday basis. And so we'll see how that plays out. To come back a little bit recently, but still not an overwhelming amount of good closes of late. And the same type of thing with days that we had positive breadth. You see back here, if we send this even further back, there were a number of days and times where we had, almost 80%, 90% of the days had positive breadth. Not so much recently. In fact, we haven't had more than 2 straight days of positive internals since those 4 in a row from the 18th of March through March 21st. Again, this is important because if this is a shift, right? If this is a shift, if we start seeing a lot more closes on the lows or at least below the midpoint, if we see a lot more days where there's just negative breadth, eventually that is going to shift momentum. Eventually that is going to cause some of the things that we looked at earlier to actually matter, right? When we see a bigger pullback from the uptrend line, we'll start to see the S&P pull back and maybe hit the lower Bollinger Band and stay there. Most importantly, that can start to make bearish patterns successful, meaning that we'll see a lower high, roll over, and finally have a downside target hit. All those things have yet to happen. We'll be keeping an eye on all of them. That's it for today. Check out these videos and subscribe. Talk to you next time.